Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing General Motors stock by analyzing its financial statements and dissecting its financial ratios so we can determine if it's a buy or a sell. GM designs, manufactures, markets, and distributes vehicles and vehicle parts. It also sells financial services. It was founded in 1908. It is the largest American automobile manufacturer and one of the largest in the world. At its peak, GM had a 50% market share in the US and was the world's largest automaker from 1931 to 2007. GM's core automobile brands include Chevrolet, Buick, GMC, and Cadillac. Let's get started with the model. This is a large cap company, 64 billion market cap. They're trading at $44.40 a share, and they have 1.4 billion shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And this company has negative free cash flow every single year. Net income is the profit and loss on the income statement. It's revenue minus expenses. So they have negative net income in 2017, but positive in the next 3 years. Their revenue doesn't look so great. It decreases from 145 billion to 115 billion. This is the company's income statement. The top line is the revenue. Below that is the cost of the revenue. Then the gross profit. Below that is operating expenses. Then you have operating income. So it is good to see they have positive operating income each year. They also have quite a bit of debt, so they have to pay interest on their debt. Then they have other income and expenses, and this is from investments or write-downs and impairments. They also have taxes, and on the bottom is the net income. So it is good they have positive net income in 3 of the 4 years. This is a breakdown of the company's revenue. GM North America has the most sales, 106 billion. Then GM International, 16 billion. They also make quite a bit of money on their financial arm, 14.5 billion. When customers want to lease or finance vehicles, they go through GM Financial. This is the statement of cash flows, and they do have positive operating cash flow each year, which is a good sign when investing in a company. You want them to be profitable on their operational business. The reason they have negative free cash flow every year is because of their CapEx. The way you calculate free cash flow, it's operating cash flow minus CapEx. CapEx is investments in property, plant, and equipment. When a company invests in capital expenditures, like when they buy a factory for instance, the idea is that investment will result in greater free cash flow in the future. And since the company has negative free cash flow, they need to fund their business from somewhere, so they do issue quite a bit of debt and equity. The issuance of capital stock was 1 billion in 2017, 2.8 billion in 2018, and then $500 million in 2019. They also issued 52 billion of debt in 2017, 43 billion, and 37 billion, and a whopping 74 billion in the trailing 12 months. But it looks like they're rolling most of their debt. They are paying a lot of it off as they're issuing it. So although these numbers don't look amazing, they don't look so terrible, but I think if this company breaks into the EV or autonomous car market, you might see their profits and free cash flow go way up. Let's look at the capital structure. They have $104 billion of debt, and their net debt, which is debt minus cash, is $81 billion. That means if they used all the cash on the balance sheet to pay down their debt, they would still have $81 billion of debt left over. They have $46 billion of equity, and they pay a really low interest rate on their debt, only 1%. So the cost of debt is 0.76%. But they are a bit leveraged at 69% debt. That means they have 31% equity. And the cost of equity is 13.5%. And their beta is 1.47. So their stock is a little volatile. It moves 1.5 times the market. Their WACC is only 4.7%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 63 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $54 billion. We divide that by 1.4 billion shares. And we get a calculated stock price of $38. They're trading at $44, so they're trading at 17% premium. It's a sell according to the model. Simply Wall Street has them valued at $44, pretty much what they're trading at. When I looked at the average analyst estimate for the future free cash flows, they had positive free cash flow in 2021, but I put it at negative because I don't think it's going to be positive next year. That's a big reason why my calculated stock price is lower than Simply Wall Street. This is the stock price the last 5 years, and it was pretty steady for a few years, and then in March it dropped a lot. But it looks like the stock price has come up almost past its all-time high. And this company pays a pretty good dividend, 3.42%. Their dividend payment has been steady the past 5 years at 38 cents a share. If you invested $10,000 into this company 10 years ago and you reinvested the dividends back into this company, you'd have $16,700 today. If you did not reinvest the dividends, you'd have $15,500. GM mentions in the 10K, we are among the leaders in the industry of autonomous technology. In terms of alternative fuel, the company mentions it offers several models in the US and Canada. The company is also working on its hydrogen fuel cell technology. GM did file Chapter 11 bankruptcy in 2009, and the company was able to shed all its liabilities and start fresh. The US Treasury gave GM $50 billion and recovered $39 billion. Resulting in a $10 billion loss. The US Treasury also invested $17 billion into GMAC, and the government was able to recover $19.6 billion, resulting in a $2.4 billion gain. That the GM bailout saved 1.2 million jobs and preserved $35 billion in tax revenue. GM has been able to report profit since 2010. The way it can do that is by reducing tax liabilities by carrying forward previous losses. The company earned $4.7 billion since 2010. The estimated tax breaks, including credits and costs related to pensions and other expenses, are worth as much as $45 billion. In 2016, GM invested $1 billion into Lyft. So as you can tell, GM is trying to branch out and become involved in ride-sharing services. This is GM's car sales in millions. 4.6 million in 1998. It peaked at 5 million in 1999. Its lowest was 2.1 million in 2009, but has come up to 2.9 million in 2019. This is GM's car sales in thousands by country. In the United States, they had 3 million of car sales, and that was 22% of the sales in the United States. In China, 1.1 million, that was 12% of China. GM sells 1/3 of the cars in Venezuela and Colombia. A concern when investing in a company like GM is its pension. So when an employee retires, GM still has to pay that employee a certain amount of money. So in the United States, GM has $65 billion in its pension plan, and in the non-US plan, it's $21 billion. Pension plans are paid out of plan assets, so the $65 billion and $21 billion is set aside to pay the recipients of the pension. GM has to pay out about $6 billion a year in pension payments. So the company has plenty of money set aside for this. Let's look at the financial ratios. The average PE in the market's 12.6, the median is 14.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 19.8, so they're doing a little worse than the average and median. The average price of sales is 6.1, the median is 2.2. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 0.5, so they have a really good price to sales ratio. Average price to book is 4.7, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. Their price to book is 1.4, so they're doing better than the median and average. Equity is assets minus liabilities in the balance sheet. And tangible equity is $36.5 billion, so they have about $9 billion of tangible assets. The average interest coverage ratio is 12.7, the median is 3.8. Interest coverage ratio is EBIT over interest expense. They're at 3.2, so they can cover their interest payments. EBIT is earnings before interest and taxes. The average ROE is 10%, the median is 11%. ROE is net income over equity. They're at 7%, so they're doing a little worse than the median and average. Average current ratio is 1.9, the median is 1.3. Current ratio is current assets over current liabilities. They're at 0.9, so they cannot cover their current liabilities with their current assets. Their current assets are $23 billion of cash, $33 billion of receivables, $10 billion of inventory, and $7.9 billion of other. So it looks like the company may fall short of cash, so they need to probably take on more debt or sell more equity just to run their day-to-day business. Their free cash flow in the trailing 12 months was negative $7 billion, and they have negative $10 billion of working capital. Working capital is current assets minus current liabilities. And the best way to look at ratios to compare them to similar companies, I've done videos on Ford, Lee, NIO, Solo, Tesla, Workhorse, and XPeng, all in the same industry as GM. And if GM has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in all the price multiples, price to earnings, price to sales, and price to book. They're not doing that well in current ratio. ROE is positive, the average is negative in this industry. They have 69% debt, which is about average, and their market cap is really high, but still smaller than the average because Tesla is so high. And they're the only company in this industry that pays a dividend. So to summarize, I do have them trading at a 17% premium because it looks like they may need to borrow more to get through the next year or two. But as time goes on, this company should become profitable. And they're kind of too big to fail, so I don't think they're going anywhere. And their ratios look pretty good. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.